So let's look at this initial public offering of Facebook as a case study and kind of show you how the volatility of these IPOs can be, and sometimes there's challenges and things around that. And a little background on Facebook. I mean, think about an exciting public offering. So many people were using Facebook. They were dominant in their market space of social media. Places like MySpace, remember MySpace, were gone or on their death throes. So Facebook is like, my gosh, they're the next Google or their next whatever. This is great if we can get in there. And there was a lot of excitement around the initial public offering of Facebook when it went from a private company to a public company. And a lot of people are excited to buy that. Now, a couple of little background things. There's some shenanigans as far as the pricing of the stock and who was getting insider stuff, who could buy it before the actual public offering or have this insider stuff and have some shares that they own. So you can read up on that, but there was a lot of stuff on lawsuits around that. I think Facebook actually was exonerated on a lot of those things too, but it was really kind of weird before the public offering. But let's look at it as an example of an initial public offering that could be good at some points or bad at some points, depending on your point of view. So let's start by looking at this chart, and we're going to look and see how the price changed over a period of time, basically over about a year and a half, almost 2 years, over a 2-year period, almost 2-year period. What happened since it was the initial public offering of Facebook, and how did the price kind of move? Let's take a look at the chart and see how it went. Okay, so if we're looking at the chart here, you'll see on the, let's just analyze the chart for a second and set it up. On the far left where it says trading days after IPO, or how many actual total days had occurred after the initial public offering from its first day of being available to the public out to 640 days later. So you can see where it went public on May 18th in 2012, and this chart's looking at to February 19th, 2014. So that period of time, obviously we were well beyond 2014, so there's been lots of changes since then. But we want to look at that initial couple-year period to get a feel for what can happen with an IPO in its early days. All right, so the share price, or at the market close, or what the offering price was going to be determined was $38, right? So the investment bankers and Facebook all got together and said, yeah, this stock is worth $38. And behind the scenes, people were saying that was way too high, but there's a lot of excitement, there's a lot of motion, so they're saying, okay, let's go for $38. And so its first day, May 18th, you can see where it says first day there on the left, it closed at $38.23, right? So it's right there, right at the close of the market or the end of the first day, they're at $38.23. If we go over to the second from the right column where it says 0.6 there, that means it was up slightly, right? They initially offered at $38 and it went up a little bit from the beginning of the day at 38 to 38.23. So up just a little bit, up 0.6. So the next thing is the first day of trading after the IPO. Now you'll notice how the date is like May 21st. That's because the weekend was in there and there was no trading days on the weekend. So that left-hand column is how many actual trading days, available trading days, is occurring after its initial public offering or after its first close. So after the $38 on this, in effect, the first or the full second day or the first full day of trading, not full day, but the first day of trading, it dropped. Oh my gosh, it went from $38.23 to $34, a little over $34. So it dropped 11% in a day and down 10% from its original offering price. So you can see how the daily change and then the overall change is on the far right column, and we really want to pay attention to that. Because you can see on the next day after that, it dropped to 31. It was down another 8.9%, or overall from its initial offering price, it's down now 18%, right? So that's the initial $38 price. So boy, we bought this Facebook stock, maybe you're excited, and all of a sudden in 2 days, you're down like 18%, like yuck. And you can kind of see how it goes from there, 6, 8, 9 days, and you can see it continue to drop each day, little blips of going up, but you're basically down 24, down 22, down 27 on day 9. You look at day 19, down 21%. Day 68, August 20th, it's down to $20, right? So there's some bad announcements and things with that. Actually, it was a good day for it on the day, because on day 19 it was up 6.1 for the day. But on August 20th, day 68 after the initial public offering, it went up 5% for the day. But really what we're looking at is that far right column. Yeah, it went up 5% for the day, but by day 68, it was down 47%. So if you had bought that stock at $38 or $38.23 on its first day, that you could maybe buy it, that was available, by day 68, less than 3 months later, it's now $20 and you're down 47%. And you're like, gosh, boy, what a bad investment, right? Now, if you stick it out and hang on, you can see what's happening in day 578. It had quite a rise. And day 642, it's been continuing the rise too. So at day 575, you're well in the black, you're made 45%, and at the end of that almost 2 years, you're down 79%. Now, when it's the bleak days and you're within 3 months and you're down 47%, you lost almost half your investment at that point. Are you willing to stick it out and hang in there? And then maybe you'll rise to that 79%, which it did, or maybe it'll continue to go down. You're not really sure. So you got to look at what's happening there around with Facebook and some of the acquisitions and things they were making in 2013, 2014. So with that, you can see kind of how it can really go down. I mean, it could have gone up too, but you can see how it really changes here. One note about like day 68, and as you're getting closer to those days, towards that 90-day mark, that's a lot of people are getting out a little bit early too, because they know the 90-day mark is going to come, and there's going to be a little bit of selling pressure from those insiders. So they don't wait till day 89. They're smart to know, like, we better get out at day 45 or day 50. Especially maybe when the stock's really going down. Sure, some of those insiders might hang on to the stock hoping it'll go up, but a lot of them are just in it to get whatever money they can, especially venture capitalists. So at that point, they're like, we're just going to get what we can and invest somewhere else. So this chart's a good example as far as Facebook. I'm not saying Facebook's a good company or a bad company. I'm using this as an educational purpose to show the volatility, especially early when we're only less than 2 years out of an initial public offering or initial public offering stock. The word to the wise on all of this is understanding what you're investing in, and think about, am I investing in this for a short-term gain? Am I investing in this because I'm trading or maybe speculating, maybe even gambling a little bit? Am I investing in this because I think there is or because it's an IPO and I'm just excited about an IPO? Oh my gosh, it's Facebook, it's an initial public offering, and I can get it for $38. Hooray! Maybe that was irrational exuberance around Facebook at that period of time. Or maybe you're a long-term investor that says, look, yeah, I know Facebook might go down in price or it might go up, but I'm here for the long term. I might own this stock for 5, 10 years, and I believe with the advantages they built in, I believe in Mark Zuckerberg and on the executive team, and I think Facebook's going to do great in the long term. Well, you were well rewarded in this particular example or case study. Now, every case is different, of course, so understand that. But the last comment or thought to leave with you around initial public offerings, for some stocks, people get very excited about initial public offerings because there might be a well-known, maybe beloved public company or a private company that's now gone public. Or maybe people have a little greed in there thinking, oh, I can buy it at this price and it'll go up, and isn't this a great thing? So just be aware of those emotions, and are you investing because it's the right thing for you and your family and your portfolio, or are you investing kind of more emotionally based? And if you are, you might want to check that a little bit and just grasp those fundamentals, look at your goals and your long-term strategy, and then see if maybe in the first several days of trading, if some of these initial public offerings fit in your portfolio. But they're certainly more risky than just stocks that have been established for years and years.